Today we're joined by Greg Johnson, CEO of Confianza, and John Petricelli, Chief Data Officer of Confianza. Greg and John, thanks for joining me. How are you doing?
Yeah, doing great. Doing great. Appreciate it.
Wonderful.
Glad to be here, Jake.
Yeah, great to have you here. So, could you both give me a little bit of background on your kind of respective histories and backgrounds? Let's start with you, Greg.
Sure. Yeah, definitely. Thank you. So Greg Johnson, proud to say I'm the CEO of Confianza, which is the culmination of many years in the world of data and analytics, starting with the early days before I'll say data was cool, when I was at EMC helping store, protect, and manage data. And then got into the world of true data with some time at some of the largest global providers of consumer and business data, and dipped my toes into the world of smaller, more niche providers of data, and really, caught a more than an ounce of excitement for and a passion about the ability for smaller businesses to deliver unique assets to the market. Built a business on the commercial side that we exited to Moody's Analytics, and continue to be extremely passionate about it. So lots of time in the industry, a lot of go-to-market focused, just about any aspect of it. I'm pleased to have JP at my side because my strengths are not the data and analytics actually, but I learn all the time from JP. So with that, I'll hand it over to JP for his introduction to balance the perspective of the organization a little bit.
Thank you, Greg. Thank you, Jake. I actually began life as an engineer designing computer boards. I will apologize up front. I'm not the best orator. But actually, I've been blessed. I've actually had three totally different careers. Started life on Wall Street as designing multi-currency environments and trading systems. Had an opportunity to move over to Big Pharma, helping to modernize the drug development. But for the last 35 years, I got introduced to insurance 35 years ago, fell in love with it, and been working there. Insurance from the outside looks very, very simple. From the inside, it's very, very complicated. And I'm really known for my analytical capabilities and finding very unique information sources and finding some very useful niches on how to apply them and really find very meaningful solutions for the industry.
Great, thank you both. So yeah, a rich background in data, but also various technologies and a lot of different perspectives, I guess, that you can both pull into insurance and data and insurance. So how about Confianza? What's the mission statement and how does Confianza fit into the world of insurance data?
Yeah, so why don't I give you, sort of a high level? The mission statement is to empower organizations to make faster, more accurate, and profitable decisions through advanced data and analytics. Boiling that down into something a little bit more digestible, it's all about enabling faster targeted risk selection, segmentation, profitable growth through the AI/ML predictive loss analytics and comprehensive data. Think of it as enabling a 360-degree view of business and consumer risk. Is sort of the way I think about it a lot of times.
Great, thank you. Yeah, and I think that 360-degree view anecdote is probably a particularly useful one because data can be used for the purposes we know it can be used for, but there's often a lot outside of data that it can kind of achieve that maybe hasn't occurred to its consumers, and particularly consumers in insurance. And so on that note, what would you say the challenges or perhaps missed and untapped opportunities are for insurers, for carriers today, when it comes to squeezing more return on investment out of both technology, but particularly data?
I don't think they have the opportunity to truly examine all the risk associated, with what they're examining. If it's easier for me to give an example. And let's choose something that from the outside looks relatively simple. Let's take a commercial property. They look at a building, they look at a unit. From the outside, it looks pretty easy, right? They look at the construction of a building, they look at the square footage, they look at the building, the building type. They look at the territory that's in. and they come up with a cost per square foot, and they insure that. They kind of look at the area to determine the liability component. What they don't look at are who's in the building, what kind of risk do the tenants represent, right? A lesser's risk view. The other thing they don't look at is what's nearby. We call it proximal. Is there a fireworks store next door, right? That if that blows up, what damage or risk does that represent? Liability risk, right? Are there, unseemly businesses, right, that could harm, the residents going into the business? There's a lot of ancillary risk that, because the data is not available to them, that they can't measure, they don't look at, and that's something very unique. That's something very unique that we have that we can offer to the industry.
Got it. So yeah, interesting perspective there. It sounds like there's always hidden risk within each risk, and having too much of a hyper-focused, perhaps laser focus on the data that you need to underwrite is going to miss data that would otherwise kind of materially change the profile of the risk.
The other thing I'd add to that, Jake, I think is a huge challenge for in the insurance industry, but I would also say it's not uncommon in other industries as well. And that's the ability to react quickly to the evolution of technology and advancements, whether it be, heck, these days we're seeing all the AI stuff, but just the things that go on within the analytics world and the latest and greatest, the new ideas that folks like JP bring to the table. It's hard to react because they all have jam-packed product roadmaps. And how do you get that out quickly? And what can companies like Confianza and Cytora do to help enable that? So I think that's a huge challenge as well. It's like the best of intentions are there, but man, if you don't have the capacity to crank it out, it's just plain impossible, so you got to pick it. So I think to the extent that we as providers of information and services platforms to the industry and to other industries for that matter, can make it easier to consume, that's a big deal. And one of the reasons that we love our partnerships with folks like Cytora for sure.
Mm-hmm. Yeah, I hear that entirely. We see a lot of the same thing. There's so much growth in what's possible and what's available that it's insanely hard to kind of build a comprehensive view of everything you can do, let alone actually implement it. And how do you filter the signal from the noise? So yeah, that's something we see a lot of as well. And you touched on it kind of briefly there. You both came from the industry's giants and have experience inside very large data providers. Why was it necessary to step outside of those massive organizations to build what you're building now? And what can a nimble team do that perhaps a legacy giant can't?
Having spent some time in the securities industry, these large companies, especially publicly owned, they've got to ring the bell every quarter, right? So there's not a lot of room for investment that doesn't yield an immediate return. Little companies like us, that's where a lot of this innovation comes from. We're not afraid to fail. We're not afraid to fail. We're very nimble. We can, if we try something and it doesn't work, we can change directions in a hurry. Of course, we have shareholders, but I can't think of what the term is, right? But we're the primordial ooze, right, where all this stuff comes from.
Yeah. It's interesting for me because my first company, I was blessed to have found a little company called EMC when it was relatively small. And we saw what it was to be the fast and the nimble and what that could do to the big. And just, it's not blasting big companies. It's just the reality. It's just harder to turn a huge ship than it is a dinghy, right? So then seeing that over the time that I was with some of the larger data providers, same thing. It's like, my God, you don't even understand how much you've got and how much you could do. So being able to be a part of an organization the size of Confianza to me is super exciting because you can listen to your clients, you can hear what their needs and their challenges are, you can react quickly and deliver fast with excellence, which is, it's just, if you like doing things fast and doing things great, and doing things for your clients, it's a perfect combination. And it's not to say that the big companies are bad. They just what they are. They provide incredible value to organizations, and it's needed. But I think it's also needed to have companies like Confianza and others that can go super fast and really listen to customers and not take 6, 8, 12 months to deliver on what they need, but to deliver right away. So it's exciting. It's not for everybody, but it's exciting.
Actually, Greg, to expand on that, Jake, our use cases really come from solving industry needs. Our customers come to us with a particular problem. The property example I gave, and there's others. We did a claims analysis for a carrier, and they had trouble explaining their losses. So they gave us a portion of their book. We did some analysis, and like them, we couldn't explain where their losses came from. So we dug a little deeper, right? We did the lesser's risk analysis. Still couldn't explain. We looked outside the building, right? Because we're really an analytical company with a pile of data. I would use a different term, but this is a podcast. So, and it was, and then we looked at the detailed occupants. And when you combine all these things together, we were able to, understand where the losses came from and gave them a better footing. But that's where all our use cases come from. We did a similar thing with crime. There's no secret that FBI crime's kind of fallen off the bandwagon. So we went out and dug up resources and built a better crime database that better explains, the impact of crime across the country. That's where our use cases come from. We're not, we can sell data, but that's really not what we do.
I think it's important because as I think of the audience listening to this, it's, you got the big companies that are out there doing it. They don't need us to go out and compete against the big guys. Frankly, why would we want to? But I think what we bring to the ecosystem of the tools that these insurers and brokers and MGAs need is we bring the ability to bring niche products that actually fortify and improve the outcomes that they're pretty much building with a platform on some of these larger data providers. So it just gives actual speed to the processing, really can help them if I think through what multi-threading through multiple partners, multiple data vendors can do for people.
Mm-hmm. Great. Yeah. And I mean, there were some really kind of rich anecdotes and intuitive examples, I think, in the message that you guys conveyed there. Being nimble allows a lot more kind of opportunity to dig into what data is going to be useful rather than relying on, we know this data has been useful in the past, so we'll kind of keep using this. And I guess insurers and carriers don't always have to look, one, to the big providers to get their data from, and two, to the big providers to get all of their data from. And I think this supports a lot of the buy versus build conversations that we hear nowadays. It's not just buy or build, it's buy to build. You can use multiple sources, integrate them, and build a system that's much more effective for your needs. And that's particularly important, I guess, when you're considering each carrier's individual view of risk required to kind of operate. So yeah, thank you for that. And I guess building off that a little bit, it seems there's a huge opportunity for carriers to, one, do more with the data they already use to increase the value it generates, and two, explore more creative sources to build a more accurate and reliable view of the risks that they ingest. And this really should be an exciting idea to many of our listeners. But you've already touched on a few of these examples, John, but perhaps you could walk us through them in a little more depth to, I guess, help demonstrate the concept and the potential scale of the benefit of a more creative approach to data utilization.
Well, sure. Actually, if we can get back down to the foundation of things, applying engineering disciplines to building models. I'm sure we've all seen the videos of bridges failing, right? It's not that the engineering's bad, right? They've done all the math. It's when you build noise into these engineering models, right, that you build in harmonics. It's funny, the same principles apply to building analytics for any industry. It always amazed me that you have you have data that has limited significant digits, but yet you're forecasting variables out to 10 or 12 decimals. And what you do is you build noise into your models, right? And then you're applying those, you're applying those factors to data, and you're essentially nullifying your models, right? So, when you build any analytical product, pay attention to the data that goes into it and limit your math, right, to the appropriate level of precision that you have. But even we talked about some property analyses. Let's talk about replacement cost. The foundation of most replacement cost estimators is pretty similar, right? You build a base, you contemplate a basement, you contemplate the cost of building a fireplace, you contemplate different materials, the number of stories, the square footage, you have hardwoods, you have a finished basement, those things are all relatively standard. However, most replacement cost estimators, number one, estimate the cost of replacement at time of policy. Well, if you look at when a claim's filed, on average, they're filed mid-policy period, right? So you should probably forecast out some kind of inflation factor mid-policy period. Well, for our competitors that do, they use the building CPI. Well, if you're familiar with the government building CPI, if you're familiar with any of the government CPIs, they're kind of manipulated to produce a number that they want to produce. We do something very different. We actually capture commodities prices from the exchanges. We have a daily commodities database of pretty much all the materials that are used. We use polynomial regressions to basically build regression lines based on the data that we get on the type of building. We can identify the kinds of materials and the percentages that they use, and we build a specific inflation factor based on materials. We don't stop there. We look at energy costs. We look at county labor rates, which are produced by the government. They're pretty good, and we literally produce an address level inflation factor for that specific property. And we've been told, that our replacement cost estimation is really, really good. We rarely lose. We do occasionally, but we rarely lose to any of our competitors. And by the way, we're not always higher. A second part of that is, we identify hundreds of building types, especially on the commercial side. And so we invoke a different model. I'll give you an example. Again, another example. It costs a lot less to build a warehouse than it does a hospital, right? If you think about all the plumbing factors, you need to transport oxygen into different things. You need backup power, of all the specialty features in a hospital versus an office building or a warehouse or a farm. These all are very, very different calculations. We account for those.
So yeah, sounds like there's a lot of information there, and to boil that down, it sounds like data fidelity is a key piece of that, and not treating every single data point in exactly the same way. Like each context of data perhaps needs a different approach. And then it seems like the other aspect is data accuracy, but accuracy is a function of not treating a data point as a static point in time. It's a living, breathing, evolving quantity that you have to take into account. One, it might change during the underwriting process, but two, are you projecting to the right time? As you say, I think the example you gave about the value of loss on a property at the point of quoting versus halfway through the policy, at the end of the policy, has the potential to introduce some real noise, as you say, into the processes for carriers. And I mean, it's clear that there's a very real opportunity for carriers to do more with data, as well as become leaner and more efficient when it comes to resource and capacity expenditure. But can we qualify and perhaps even quantify the magnitude of that opportunity? Are there any specific measurable benefits and potential impacts on carriers?
When we've had the opportunity to compare what we calculate to when carriers have exposed their current calculations to us, we've seen a 20 to 40% difference. So it's significant. And again, and most of it really isn't the calculation. It's really the difference in the context, right? It's forecasting out. Um, and at times when these factors are accelerating, we're in a period now where commodities are falling, with the exception of steel. Now, I'm hoping that's going to change, right? I don't know if you're familiar with the economic news, but for the first time in almost 30 years, the U.S. has produced more steel than Japan. So I'm hoping that the steel futures are going to compress a little, make it more affordable to build a commercial building anyway. But I'm hopeful now that our forecasts of commodities for commercial buildings is going to come down a little.
The other piece, I think, Jake, when you talk about the quantify the impact, we talk a lot about the underwriting and what you learn from underwriting, and how the things you learn by making adjustments to the underwriting process can bring information that you can apply elsewhere. But one of the things that we're seeing and hearing a lot right now is this whole concept of portfolio optimization. So you can make all the decisions you want over a 6-month period, but then you're going to have those policies for a year, 2 years, and hopefully a lot longer than that. So being able to explore and look at the existing portfolio and say, what are we seeing for opportunities there? Where is there leakage? Where is there room to optimize, to cover potential claims? And dare I say, even to potentially reprice, or at least make sure you're on par so that people don't leave and the policies stay. All of that to say, as you run the portfolio optimization to get more profit, more income out of the portfolio, that can also be applied immediately back to the underwriting process, because the easiest way to make sure you've got a clean portfolio ultimately is to make sure you're putting the best stuff in, right? So portfolio optimization is a big one, and being able to bring those new data elements that JP talked about into the portfolio and evaluate the risks and the opportunities within the portfolio, at the same time going to the new policies that are being underwritten. But the bigger population exists for most in the existing portfolio to be optimized. But that's a big trend that we're seeing, and then being able to apply the results in both directions. I guess you can kind of look at it at any stage, whether it be renewal, midterm, or underwriting, but then leveraging them across the other three.
I mean, we spent a lot of time talking about property. How about auto? How many auto policies have a material change in their first year? You have a guess?
Oh, I'd be hesitant. Go on, hit me.
10 to 15%.
So
right?
significant.
And again, auto writers just tend to auto renew without re-examining, right? The household location, and we're in an era where most policy decks are delivered right through the internet to email. They don't even know if a policyholder's moved. Could be a completely different territory. There could be someone new in the household. I mean, it's truly amazing.
The other one, I think, JP, you've talked a lot before on that same topic, is talking about the portfolio and the applicability back to the underwriting, is the carry forward, as I like to kind of think of it, the carry forward of information that might not be 100% accurate, right? So what is the information? Can you identify those households and the value of the data that we bring? But can you identify the household to make sure that there are a certain number of people or in the household, and that there isn't missing people or something, and making sure that the policy that preceded maybe the policy that's being considered now is accurate information as well. I don't know if you want to talk about that, but I think there's some incredible value. I always love that part of your conversation too.
Well, I mean, the industry relies on contributory databases, right? What can be better than knowing what the prior policy was? And again, this is not a dig at the providers of that data. They do a tremendous job, and as providing information to the industry. However, the process of insurance is becoming more anonymous. Consumers don't know, what's necessary to insure. They don't know what to respond. So there's typically missing factors. They don't know to auto report the 16-year-old or a cousin or an aunt or a parent living with them. Those are all exposures to vehicles, similar things on the property side. These all become risks that are not reported on the policy. The next insurer that comes in to quote the policy, these aren't there. They're not contemplated on the new policy. You get into agents. These are probably less innocent. An agent gives a quote. When I used to run a call center, we used to listen to agent calls or call center calls. The first quote, you can almost hear the customer hit the floor when they get the quote for $3,500 for a policy period, right? Why? They have a 16-year-old, they have a 80-year-old parent 80-year-old parent. They live in a high-risk area, right? Call center reps compensated to sell a policy. So now the territory changes. There's a whole thing about territories I won't get into, but they change the territory. Mail still gets there. They drop the 16-year-old. They ask how old grandma drives the car. Well, we will leave her off the policy. Now the premium's $1,500. They write the policy. Again, next carrier comes in. They write the policy. Everybody's happy. There's about a 10 to 15% premium leakage, right? That the next carrier doesn't know about. These are material things. These are all things that can be remediated, for people who can build households, as we can, there's a lot of inherent, I don't know, let's call it danger, right? With current information. And again, it's those environments are intended to be tips and leads. Unfortunately, the carriers don't have the means, right, to, and up until recently, don't have the availability of additional data.
Yeah, so I guess what I'm hearing is, the opportunity it's almost endless, really. And on the examples you gave, if translating those maybe into commercial lines, would you say that the potential, the opportunity there compounds? Because I guess in commercial lines, there's perhaps more variables, there's more exposure, there's higher value premiums, and so translating all of that into those kind of aspects I mentioned, it sounds like that opportunity is enormous as well.
Well, think about it, right? On the personal lines, you've got, auto, property, umbrella, and maybe a couple of other small ancillary. Think about all the products on the commercial lines, right? There's got to be 30 or 40 product lines, right? So you've got 30 or 40 challenges, right? All that require unique and different uses of data. So you're right. And you brought something very interesting up before. It's a word that I'm glad I hear coming out of somebody. Context, right? The ability to take information and put it into the right context. That's key. And that's why, you can put a room full of data scientists and give them information and claims. And without the ability to put the two together in context, doesn't necessarily result in the outcomes you want.
Yeah, and I think that's an intuitive and quite easy to grasp concept, but the challenge comes in trying to implement it, really. And this probably takes us back to what you mentioned about the benefit of working with more nimble organizations, and equally not looking to kind of source all of your data from a single place, but choosing the most appropriate and most relevant places for that data, to be able to build a system from component parts that's going to serve you as a carrier and your appetite best. And on the opportunity piece, so we've covered a couple of different opportunities there. We've covered the new business opportunity, the portfolio enhancement opportunity, but I wanted to ask you about another potential opportunity, which is the risk of ignoring. So what can be said for carriers who fail to adapt and adopt technological transformation and advancement whilst their competitors implement new technologies and make better use of data?
Oh, I think they're going to be adversely selected, right? I think the news for them is going to get worse, and they're going to, their loss ratios and combined are going to continue to erode, right? It's funny. Agents are clever people, right? Especially the independents, right? Who have, 10 carriers to pick from, right? As they identify more, higher risk individuals, they're going to place them with people that they know they can place them with.
It's we've just had some JP and I were on some calls in the last couple of days talking about it and talking about some of my from a personal experience with a recent house purchase, the experience that I had with some of the newer carriers, and you can see them coming in with a blank sheet of paper and saying, "Man, we've done it elsewhere. We come from other organizations, but with the blank piece of paper, how can we make ourselves even better, faster? So how can we underwrite more quickly and more accurately?" And so I think the risk of ignoring is it's some of these fast insurers that I see or saw in my personal experience who had some just incredible questions they were asking, things I'd never been asked before. And I'm by far and away not an expert on insurance in particular. Data, yes, but not insurance. And talking to JP about it, and he's like, and some of the other members of our team, that was exactly it. The risk of ignoring is ultimately leaves people paralyzed. But then you've got that other problem, which is you've got this massive amount of infrastructure that you've got to continue to maintain. So how do you act nimble when you've got this burden of being as big as you are, right? And I think that's where we can help organizations, both big and small. I saw it in the underwriting space. I was in the leasing industry for a long time and served them. Same thing. I mean, some of the bigger leasing companies that were doing underwriting of leases were losing to those that said, "I want to be able to make a decision in under a minute for a business," right? And that's super fast. So the risk of ignoring to me is huge in terms of market share loss, long-term and or leakage with renewals and that type of thing.
Yeah, I mean that all resonates a lot, and the opportunity for differentiation through technological adoption it's only accelerating, and I think all the kind of the examples you gave there highlight that perfectly. There is one other thing I wanted to ask you guys. So we often speak about how carriers using better data in new ways can surface risk profiles that fall outside of appetite, thereby saving resources by either reducing underwriter time spent, investigating and quoting, as well as avoiding binding inappropriate risks. But what about the other way around? Is there a reason that better use of data can't expose new potential sources of written premium that at first glance might seem irrelevant, but upon further investigation are actually within appetite?
Yes, the simple answer. And it's funny, not all data represents premium, or not the use of data doesn't necessarily have to result in additional premium. Identifying behavior. Let's talk. I'm gonna talk about the negative first, right? Identifying, let's call it aberrative behavior that is going to result in something, right? Well, let's call it a knockout. Where the basic fundamentals look good, decent credit score, decent location, but this person doesn't have necessarily, have a bad history of claims, but they've got a history of behavior that results in claims. But on the other side, bad things happen to good people. Stuff happens. A pipe bursts. It's something that happens to a building. It's not associated right with a person. So again, looking at someone's behavior rather than penalizing someone because something bad happened that they had no control over. Let's really look at the risk that the person, right? Secondly, looking at the complete profile. You may be looking to sell someone a homeowner's policy. There's some simple things you can do to look at what their entire insurance footprint looks like. And let's reward them, right? Offer them a bundle where now you can, there's enough information out there to identify what their auto footprint looks like. Do they have excess assets where they now could potentially use an umbrella? Do they have some life events, right? Did they recently have a child? Are they did maybe they're nearing retirement, so they potentially need some kind of a retirement package or an end of life package, etc. But taking the agent, and the agent's been relegated now to an order taker. Here's an opportunity for the industry to bring the agent back to that of a trusted advisor where they used to be.
I think that one is huge, JP. We talked about the risk of ignoring for the carriers, but there's, from a personal perspective, I look at it and say there's a risk of ignoring for me as well, right? We talked about replacement costs and replacement cost estimators and the CPIs and the indices that we use. But if I'm underinsured on the replacement cost of my home, there's a huge risk to me of ignoring, whether it be on complete destruction of the home, unfortunately, but also even on basic claims. So I think the notion of informing and becoming that trusted agent is huge, and a bit of a hard balance to keep, because as consumers, what do we want? We want it all. We want it fast. We don't want to really have to talk to anybody. I don't, right? I mean, I got 5 minutes my day. I need something. I'm going to get it. And if I can get it online, I want it. So how do you bake that trusted advice into that online reality experience of instant gratification that we as consumers have unfortunately become, to expect in our interactions with businesses as well?
Absolutely. And again, I think context seems to be one of the things that ties this all together. And again, extrapolating that out into commercial lines, added variables, added exposure, the opportunity only seems to be getting bigger. So I suspect listeners to this are going to come out of it with a very kind of comprehensive but actionable list of tasks to look at, and new ways of kind of looking at the data they use and how they acquire that data to improve kind of operational ratios and any other business outcome that they're aiming to achieve within their carriers. So no, thank you for that, guys. I do have one more quick fire question for each of you. So if you could each change one thing about the insurance industry, what would that be and why?
I'm very fortunate to have somebody like JP as a resource to me. And every time I have to make an insurance decision, I call JP. So that's valuable. But my thing, I guess, is outside of all the data and technology and platforms that we talk about all the time. I'm a big believer when I go in to meet with my customers about being insightful and bringing knowledge and bringing something that may have nothing to do with what we're actually delivering as a service. Right? We get the opportunity to talk to a lot of people, and we know our data very well, and we know the industry and those around us very well, both competitors and complements. I think for the insurance industry to figure out how they could educate consumers on insurance would be tremendous value. And I think it would inure to the benefit of the insurers as well, because I bet they'd pick up insurance policies that they might not even expect, but educate and help us as consumers understand, why am I underinsured on my home or on my car, or do I need liability, that type of thing. I think that would be a huge benefit. So kind of off the grid from the data conversation that we've been talking about in the US, let's talk about, Jake. But if I could change anything, that would be fairly selfishly one of the things I'd like, and JP would like it because he'd get fewer calls from me too.
Yeah, no, it's a great answer regardless of the context. And how about you, JP?
As the geek, I have a totally different perspective. The process of insurance really hasn't materially changed in 50 years. We may be providing different information sources and quantifying risk, but we're quantifying risks pretty much in the same way, right? We're looking at the financial viability, their ability to pay. We're looking at the territory where the risks are. We're looking pretty much at the same risk factors. I think the industry really needs to take a different look at the risks associated with what they're insuring. I think it's time really to take a deep look at the process of quantifying risk.
So yeah, better data, more data fidelity, better context on that data, and don't miss out on these opportunities to differentiate, because they're not going to be here forever. And now is the time to move forward. So yeah, on that note, thank you guys. That's been a super insightful conversation, a lot for our listeners to implement, and certainly a lot for me to take away from it. So thanks for joining us, guys. It's been absolutely great.
Jake, thanks for having us.
Appreciate the opportunity.